All right, let's jump right in. Welcome to this explainer, where we're going to unpack the absolutely fascinating and incredibly complex tug of war happening between the Indian rupee and the US dollar. Now, if you've been keeping even half an eye on the financial news lately, you already know the rupee has been under immense pressure, hitting near record lows. But we aren't just going to stare at a bunch of numbers today. No, we're going to pull back the curtain and look at the deeply interconnected global machinery that actually drives those numbers.
To start things off, let's bring this right to your front door. Have you ever wondered why your favorite imported smartphone, or honestly, even just a regular tank of petrol, suddenly costs way more today than it did yesterday? Especially when the actual price tag in US dollars hasn't changed at all? Well, the answer lies in the invisible economic forces that are directly impacting your wallet right this very second. It all comes down to currency depreciation. Think of it like a trip to your local Kirana store. Imagine you regularly buy an imported packet of biscuits that costs exactly $1. A few years ago, you might have handed the shopkeeper 75 rupees for it. But if the rupee depreciates, suddenly you're handing over 82, 90, or even 96 rupees for that exact same packet. The biscuits didn't change, but your currency lost some of its purchasing power against the dollar. So let's get into Section 1, the rupee's roller coaster history. A quick look back at the INR to USD exchange rate. To really understand our current reality, we have to rewind a bit. Back in 1947, $1 equaled just 3 rupees and 30 paise. Over the decades, massive historical events shook that foundation. You had the Nixon shock in 1971, which completely changed the game. Then came 1991, a pivotal year of economic liberalization in India, where the dollar sat around 35 rupees. We navigated the 2008 global financial crisis at around 43 all the way to 2026 projections, where we're seeing rates inching dangerously close to the 96 mark. It's been quite the ride. Because, you see, currency doesn't just exist in a vacuum. Whether it was the 1970s Nixon shock or modern-day policies like the 50% U.S. tariffs on Indian imports, political actions frequently act like massive wrenches thrown directly into the delicate gears of the global currency machine. The second political friction happens, the currency markets immediately feel the heat. Which brings us to Section 2, why the rupee falls. Let's look at the heavyweights pulling the rope. Right now, we're basically looking at a perfect storm of intense pressures. First off, you've got steep U.S. tariffs hurting the competitiveness of Indian exports. At the exact same time, foreign portfolio investors have pulled over $18 billion out of Indian markets. When they leave, they sell their rupees and buy dollars, which literally creates a dollar shortage. Combine all that with a widening trade deficit and a naturally strong U.S. dollar backed by high Federal Reserve interest rates, and, well, the rupee doesn't stand much of a chance. In this macroeconomic tug of war, the Indian rupee is really struggling with that widening trade deficit and massive capital flight. On the other side, you've got the US dollar, the undisputed heavyweight champion. And what's really interesting here is the dollar's status as a safe haven asset. Whenever there is global geopolitical uncertainty, investors panic and immediately flock to the dollar for safety. That massive global demand inherently makes the dollar stronger, which, by mathematical default, just pushes the rupee lower. Now let's explore Section 3. The petrodollar and the rupee, or as we can call it, the manager in the corner of the heavyweight champ.
85%. I want you to let that number sink in for a second, because this is the harsh reality for the Indian economy. That is the percentage of crude oil that India must import from the global market just to keep the lights on and the economy moving.
And here is how that builds a relentless structural loop. Step 1. Global crude oil is strictly priced in US dollars. Step 2. Since India imports 85% of its oil, it has absolutely no choice but to constantly buy billions of US dollars to pay its energy bills. Step 3. This creates a permanent, massive demand for dollars. Step 4. This soaring demand for the greenback automatically pushes the rupee's value down. It's an automatic cycle that is incredibly hard to break. As our sources highlight, a sustained increase in crude oil prices has wide-ranging implications. Whenever tensions in the Middle East cause oil prices to spike, India's demand for dollars skyrockets right alongside it. That creates immense pressure on foreign exchange reserves and leads straight to further rupee depreciation. Let's move on to Section 4, impact on retail markets, the real-world casualties of this currency war. So what does this actually mean for you? Well, there's a very real-world divide here. A falling rupee isn't bad for absolutely everyone. If you're an IT company, a pharmaceutical exporter, or a non-resident Indian sending money back home, you're actually winning. You get way more rupees for every single dollar you earn. But for the average consumer,
Yeah, you take the hit. You're facing higher costs for fuel at the pump, pricier imported electronics like laptops, more expensive raw materials, and even costlier overseas education for students. It's a phenomenon called imported inflation, and it triggers a massive domino effect. When the rupee depreciates, the basic cost of importing fuel rises. When fuel costs rise, the cost of transporting absolutely everything inside the country goes up. Raw materials get more expensive. It's a brutal chain reaction where a weaker currency directly translates to higher inflation for everyone, which can then force the Reserve Bank of India to tighten interest rates, making borrowing money more expensive too. The whole shebang. So, how do we fix it? That brings us to Section 5, how to overcome this. Winning the game. Overcoming this severe currency depreciation requires two entirely different playbooks. In the short term, the Reserve Bank of India steps in. The RBI has a massive war chest, around $690 billion in foreign reserves. They can sell those dollars into the market to absorb rupees and manage extreme volatility. But, they can't just burn through those reserves forever. The long-term playbook? That requires actual structural economic shifts. We're talking about boosting domestic manufacturing to rely less on imports, and most importantly, reducing that massive oil dependency. A big part of the immediate relief also relies on international trade agreements, like resolving those deadlocked negotiations regarding heavy tariffs. However, as we're impartially observing from the sources, these types of high-level geopolitical trade negotiations tend to move, well, at the speed of a bureaucratic snail. Seriously, relying solely on foreign policy shifts is just not a reliable strategy for domestic economic stability. Therefore, to truly stabilize the currency from within, India has to accelerate structural reforms across labor, land, and tax. That's how you attract long-term foreign direct investment instead of just fleeting portfolio cash. We need to boost credit flow to MSMEs and infrastructure. Businesses absolutely have to manage currency risks through smart hedging, but honestly, perhaps the biggest game changer is a massive, aggressive transition toward renewable energy. Generating power domestically is quite literally the only way to break that relentless petrodollar oil import loop. Which brings us to the ultimate question. As long as the global financial system is fundamentally wired to run on the petrodollar, can the Indian rupee ever truly break free and stand entirely on its own strength? Or is the nation's economic destiny forever tethered to the price of the next barrel of crude oil? I'll leave you with that final provocative thought to consider as you watch the markets this week. Thanks for joining me on this explainer, and keep questioning the forces shaping our world.